So in my previous video, I talked about the difference between a passive investor and a defensive investor. I didn't get to finish off the defensive investor part, so I'll briefly explain what a defensive investor is. A defensive investor is pretty much almost exactly the same as a passive investor. It's more so somebody that's risk averse and doesn't want to necessarily assume a lot of risk and kind of wants somebody to blame or something else to blame if their investments don't go so well or don't go as well as they planned. So what a defensive investor would do is they'll give their money to somebody else so that they can so that person or organization can manage their portfolio and trust in that organization or person to yield them returns, satisfactory returns anyway. So that's what a defensive investor is. It's just somebody that avoids risk as much as possible with regards to investments. Investments in the stock market in general are risky anyway, but risky when it comes to investing, risky doesn't necessarily mean what the layperson might think it means. There's ways of hedging risk with risk management. I've talked about these terms in previous videos. I've made videos on risk management as well as active investors. Sorry, not active investors. Risk management and just general definitions of terms I've talked about in previous videos. So if you're trying to figure out, if you're a bit confused on terms that I'm talking about, just look at my previous videos or go on Google and whichever way is better for you. But in this video, defensive investor is pretty much the same as a passive investor, just not necessarily wanting to be so involved in managing the portfolio. Maybe you're busy, or maybe you just don't want to be responsible for the portfolio not performing so well. So you usually hand out your money or turn over your money to a professional or somebody that you trust that has hopefully that has past performance that's pretty good, and you trust them to try to emulate that performance.